Alright, I want to talk now about the options that are embedded in mortgages. Typical mortgage in American housing finance. And I want to say that there is, in effect, an option on home prices because the borrower can default, and there's an option on interest rates because the borrower can prepay. So that the lender or investor or somebody is short these options, has written these options, and the borrower has obtained these options, so they're long these options. So these options work to the benefit of borrowers, they're to the detriment of lenders. Now, of course, they're going to have to be priced into the cost of the loan, so on average, the lenders and investors and whoever guarantees mortgages, they're not going to lose money on average, just as an insurance company is not going to lose money on average writing insurance, but they're in the position of being short the option. So let's talk about the home price option first. So it's pretty simple that when you own a home, you've borrowed. Let's say you've borrowed $90,000 on a $100,000 home, and you get in trouble. You can't. You've lost your job, or you can't make the payments. If the home price has stayed above $90,000, then it makes sense for you, in order to pay off the loan, let's just say you can't possibly make the payments, it makes sense for you to sell the home, take the money out of it, $95,000, $100,000, $105,000, use $90,000 of it to pay off the loan, and keep the rest of the money. So as long as prices go up, you're not really going to default. You're going to sell the house rather than default. So it's only if prices go down that you will default. So we've talked about that before, but that means there's sort of an option characteristic. That is, until the option to default is in the money, as soon as the home price becomes less than the loan amount. So people talk about your mortgage being underwater, and by the same token, when the house price is less than the loan amount, so your people call the borrower upside down, or the mortgage underwater, and from the point of view of the lender, the default option is in the money. Now, the borrower won't necessarily default, but that can be one of their choices, and if they do exercise the option to default, then the lender is going to lose some money, because the lender can only recover, at least in most states in the United States, the lender can at most recover the value of the home, and that will be less than the loan amount, and so the lender will not come out whole. So the option's in the money, and the lender can lose from a default. And so that's a sense in which an option price framework works there. And in terms of interest rates, there's the option to prepay. So if you have a 4.5% mortgage and rates fall to 4%, then you can refinance into the lower rate mortgage, and the lender, who is kind of enjoying this 4.5% mortgage rate, will lose the mortgage either to another lender, or they can refinance it themselves. But either way, if market rates are 4%, the lender is going to give up a 4.5% loan, and at best replace it with a 4% loan. So that's the option to prepay a mortgage. So under American mortgages, the borrower has the option to prepay at any time, and usually without paying a prepayment penalty. In fact, I think the legality of prepayment penalties is even questionable if a lender wanted to charge it. I want to point out that when I was first kind of in the mortgage business in the mid-1980s, these options were less valuable. So the options were less valuable in the 1980s. And it's for a couple. So for the default option, the main reason that the option on home prices, or the default option, was less valuable was that there were higher down payments. Maybe less valuable might not be the best term, because an option can be valuable even if it's deeply out of the money. Maybe another way of putting it would be they started out of the money, deeper out of the money. And the reason, again, so if you have a higher down payment, then the default option is further out of the money. That is, if I make no down payment at all, let's say on a $100,000 home with zero down, then if the house drops by a penny, the default option is in the money. So any home price drop makes it desirable to exercise the default option. But if you have a $100,000, let's say with $20,000 down, which was more normal 30 years ago, then the price has to fall to $80,000 before the default option is in the money. So again, the moral of the story is the default option used to start out way out of the money when people made larger down payments. And the reason that the interest rate option was more out of the money is it used to cost 2% or more to refinance. And so when it costs 2%, that's a serious deterrent to refinancing. Well, now it typically costs less than 2%, maybe less than 1%. So you can refinance more cheaply. I mean, the lenders will actually advertise it as zero cost refinancing. I'm not sure it's it can't be exactly zero. I mean, they do go through some processing, but often it costs them very little to do a straight rate and term refinance. And the fact that it costs them so little means that you need a much smaller drop in rates to make a refi worthwhile. So it used to be, the interest rate would have to drop, like at least 1.5 percentage points. Let's say in 1986 or 1988. But now, if the rate drops a quarter, it might very well pay for somebody to refinance. So that means that the almost from the day the mortgage is issued, the interest rate option is at the money, is close to being at the money, and whereas it was significantly out of the money back when refinancing costs were higher, when the technology of refinancing was less efficient. The interest rate option was not worth as much. So the net result is that these options have become worth more, and I think what that has to mean is that in a kind of a completely free market, a 30-year fixed rate mortgage should be expensive. So because the 30-year mortgage with no prepayment penalty and with no prepayment penalty and no recourse, meaning that that the only thing that the lender can go after if you don't pay off your loan is the house. Can't go then try to go after your income or your savings. So with no prepayment penalty, no recourse, that means sort of the options are present. The rate has to be high now in order to include the option premium. That is the premium for the option on house prices and the option on interest rates. Those options have become more valuable because of these factors I just said, so that the rate would have to be high because of that. And so we can maybe come back to that near the end of the course when we're talking about sort of the outlook for policy going forward. But the important point to take away from this talk is that you can think of default and prepayment as embedded options in mortgages. They're like options on house prices and options on interest rates, and that is very insightful in terms of understanding the pricing and risk of mortgages, and we'll get into that next time.